Hi, everyone. This is John Vecchio from Hidden Profits. And in my last Rich Investor, I put up a chart from Goldman Sachs that shows that we're in a very risky period of the market fundamentally. They look at things like valuation, unemployment, the yield curve, and some other fundamental factors that show that not only are we in a risky period today, but generationally, really the riskiest we've been in since the late 1960s. And the problem with that is that fundamentally we've been in a risky time period for quite some time. For example, valuation-wise, we're in nosebleed levels relative to the sales in the S&P 500. I mean, it's multiple standard deviations away from normal. But that hasn't stopped the market from going up. But now we're in a period where actually the market is starting to show some weakness technically, and specifically the 200-day moving average, which is kind of a nice line in the sand that you can easily see in the market. Since 1929, when the market's been above the 200-day moving average and it's moving up, the returns are about 7.75%. When the market's going down and the 200-day moving average is moving down, the returns are about 1.2%. So we're in a period where we not only have fundamental risk, but technical risk as well. And I basically think of those as technomentals, combining the two. Most people are either fundamentally driven or technically driven. But when you look at both today, they're actually converging to show very significant risk in the market. Doesn't mean that it'll go down. There's been false starts in the past before where the market dipped below the 200-day moving average slightly, only to rebound, and people have been buying the dips. But we're starting to have a lot of headwinds in 2019. The tax cut will start to anniversary. Stock buybacks were big in the first quarter of this year. They will start to anniversary next year. Specifically, Apple was about 50% of the buybacks, depending on what time period you look at. It's probably not going to happen again. So we have some headwinds going into 2019. And I just wanted to reiterate what I had in the other Rich Investor, which was to consider risk probably more than ever before in this bull market. It's been very easy to buy an index fund and ride the wave up. Those good days are probably coming to an end, if not over altogether. Tighten your stops and think long and hard about where you commit new capital. Cash sleeps softly at night. The yield on CDs is actually higher than the dividend yield on the S&P. So we're starting to get some competitive rates, although they're not high, obviously. They are competitive versus where they were in the last 8 to 10 years. So just think about that. We're starting to see now for the first time the technicals and the fundamentals converge and show that we're in a very risk time period for the market. I'll be back again sometime soon with another video. Until then, take care.